You're contributing to your 401k, you're investing diligently, and yet you still may be quietly leaving six figures on the table every few years. Here's why. A simple 2% tax drag from holding the wrong assets in the wrong accounts can cost you over $170,000 over 10 years on a 500K account. Same portfolio, same market, just different placement. I'm Dan Pascone, founder of Tailored Wealth. We help business owners and executives to optimize investments, reduce taxes, and align money with life goals. And today I'll help you to find and fix the $100,000 asset location mistake that most busy executives make. I say it all the time. Control is the ultimate asset class. Not another hot fund or clever trade, but where your assets live, how dollars flow, and how gains get taxed. Here's the simple playbook that we use with our clients, step by step. And I'll point out the spots along the way where I see the biggest leaks. And if you want ongoing bite-sized playbooks like this, visit our free content hub for high-earning executives at makingsenseofyourmoney.com. Okay, first, here's a quick sanity check. Asset location is not the same thing as asset allocation. Allocation is what you own. Location is which type of account owns it. We always talk about three buckets: tax deferred, taxable, and future tax free. If you get allocation right, you'll grow. If you get location right, you'll be able to keep more of that growth. The first mistake that we see is tax inefficient investments sitting in taxable accounts. Bond funds throwing off ordinary income, active funds producing short-term gains, and REIT distributions getting taxed at the top of your bracket. So here's the fix. Move bonds, REITs, and high turnover funds into tax advantage accounts when you can, and keep broad, low turnover index funds in your taxable accounts. Result, you lower your annual tax drag without changing your risk. Mistake number 2 is ignoring the Mega Backdoor Roth. Many Fortune 500 and growth company plans allow after-tax 401k contributions plus in-plan Roth conversions. Translation, you can put more into a Roth each year regardless of your income and let it grow tax-free. I tell every prospective client that I meet with to ask their HR team if their plan supports after-tax contributions with in-plan Roth conversions. The answer is yes. Set a per-paycheck percentage to hit the plan limit by year-end and turn on automatic conversions. That one switch can be a six-figure swing over a decade. Mistake number 3 is leaving your employer match or profit sharing uncoordinated. You may be maxing your pre-tax contributions, but your company's match might land differently than you think. The fix: confirm how and when the match happens. Then coordinate your deferrals so you capture every employer dollar early without tripping compliance tests. Mistake number 4 is not having a written asset location policy. Without a plan, rebalancing over time puts the wrong assets in the wrong places. The fix is to create a one-page asset location IPS, which simply defines the hierarchy. Bonds, REITs, and high yield go to tax deferred. Broad equity funds go to taxable. High growth and long horizon equities go to Roth. And add rebalance bands so changes only happen when weights drift, reducing churn and taxes. Mistake number 5, and this is a big one, paying taxes that you don't have to in retirement. I see this all the time. You've saved well, but your withdrawal plan is random. The fix is to sequence withdrawals deliberately. Now, everyone's tax situation is unique and different, but generally speaking, you should start your withdrawals from the taxable accounts, then move on to traditional IRAs and 401ks, and save the Roth bucket for last. And use lower income years to do Roth conversions or partial IRA draws. The right order can add years of tax-efficient runway. Now that we know the mistakes, let's set up an automated system to be sure that we avoid them. Step 1, create an inventory by tax bucket. List every account: 401k, IRA, Roth, HSA, taxable brokerage. Mark each one as tax deferred, taxable, or future tax-free. When we do this for our clients, our software literally shows the dollars leaking from tax drag. Step 2 is to map each holding to its tax home. Bonds and REITs, tax-deferred. Broad equity index funds, taxable. High growth strategies, Roth. And if you run out of space, prioritize by tax paying and turnover. Step 3 is to turn on the Mega Backdoor Roth if it's available. Set a steady contribution so you hit your annual limit by year end, and enable automatic conversions so those tax dollars don't sit and generate taxable growth. Step 4 is to automate rebalancing where taxes are lowest. Do it inside your IRAs and 401ks first. And if you must rebalance in your taxable accounts, use new cash or dividend redirects instead of selling. Step 5 is to add tax-aware cash flows. Redirect dividends in taxable accounts to your highest priority buys, and set up a tax sweep when you realize gains so that April never surprises you. Step 6, write your one-page asset location IPS. Include your hierarchy, your rebalance bands, your Roth playbook, and your cash flow rules. This removes the guesswork, especially when life gets busy. Now here's a quick case study. A VP of sales with a $1.2 million portfolio, bonds sitting in taxable, RSUs landing in the taxable brokerage, and no Mega Backdoor Roth. We moved bonds into tax-deferred, shifted broad equity funds into taxable, directed growth funds to Roth, and turned on the 401k after-tax conversions. The projected 10-year benefit? Well over 6 figures with zero added risk. Now make it a family system. Do a 20-minute money huddle this month and cover 3 things: where each account lives, tax-deferred, taxable, future tax-free, which assets go where and why, and 1 action to complete this month. Maybe it's the Mega Backdoor Roth or moving that bond fund. At Tailored Wealth, we act as a fiduciary, building this architecture into one coordinated plan. Investments, taxes, equity comp, estate, and risk. You get one dashboard, one team, and complete clarity. For more executive-level insights, visit makingsenseofyourmoney.com. The link is below. The 100K mistake isn't performance, it's placement. Fix the location and keep more of what you've already earned. If this helped, like and subscribe, and comment below which move are you making first. Turning on the Backdoor Roth, moving bonds out of taxable, or writing your asset location IPS. I'm Dan Pascone. Let's go get that 100K back.